Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
All right, for this pod, Rory, you have found another article for us to dive into.
Clickbait strikes again. They got me. They got my algorithm in holding it hostage. So I saw this this article with the title "Private Equity Assets Stuck in Zombie Funds Are at Record High." And so I had to click through and read about it. And, it put some numbers behind some actual trends that we've talked about on this show about how, more recent funds are having longer duration for so many different reasons. But it's something like $348 billion of worth of assets under management. So how much these funds manage in terms of portfolio company value. $348 billion in net asset value is in funds that are greater than 10 years old, which is a lot. That's significant. And yeah, I found it real interesting. Some of the things they talked about kind of aligned to some of the trends we've been speaking about as well from the economy standpoint. And just this term zombie funds just made me chuckle a little bit because they're certainly not zombie funds because zombie implies dead. No, these are
like these are very
much alive and active. And I guess zombie implies reanimated. So I don't know if that's even happening, but it made me think about a few things. And not only just what I was just mentioning around like the reasons why it's taking funds longer to liquidate portfolio companies, but also the fact that I've been in operating companies, so is Ed, that are in the tail end of a single fund and how that ends up going, right? So think about it in some ways if there's a new shiny toy, people move on from one to the other. You have to manage the old toy or, maintain it or whatever, but there's this new toy to go do lots of cool shit with. So it's interesting to be part of a company that's kind of at the tail end of a fund, so to speak. And so that got me thinking about that.
Yeah, I think of zombie as The Walking Dead, which
literally.
One, you had to die first, and two, you kind of got Frankensteined back into some medium life space.
Yeah. It's an interesting dynamic, and I think the other stat was 74% of the private equity value is currently locked up, meaning it hasn't been sold, and that's I guess almost 4 trillion based on the numbers that we had calculated before of roughly 5 trillion, something like that of PE value. So a lot of this stuff is just it is truly illiquid until you find a buyer. And there's a lot of reasons why companies aren't selling as fast. We've talked about, interest rates rising. So being able to command a premium on what you paid back in 2020 and 2021 with higher interest rates, which means higher cost of borrowing, it's going to be a tall order. So you're then faced with, do I sell at a loss or what, right? Or do I restructure this balance sheet? Who knows? There's all myriad of reasons, but it's not the easiest market to just flip companies these days to a buyer for profit a meaningful profit.
Is there a scenario though where you go, look, I have to cut my losses on this one to go get another one that could then make up for them, hopefully?
Yeah, definitely. And that's where you start to see things like inter-fund dynamics too. Again, funds are not, I don't know, it's regulatory and just otherwise fiduciary where funds are not supposed to be commingled, which means you're not supposed to necessarily have, assets going from one fund to the other self-dealing. I mean, we've been through that kind of stuff. We had to structure workarounds where it'd be not an actual, ownership stake in this company by the same affiliate fund, but rather an SPV owned by that new fund that invested in the old. There's a lot of ways to work around that, but
Well, and it does
you're
open,
really
it
not supposed
opens
to do that.
the private equity firm up to, if the limited partners aren't the same in the
Yeah.
fund, so it opens them up to lawsuit, because the valuation is such that, these guys may go, you're trying to subsidize this other
Yeah.
limited partnership group,
Yes.
and or you're trying to cover your mistakes with our capital.
Mhm.
And
Oh,
those folks have to pay for the mistakes, not this fund, that other fund.
wait. So run me through a scenario. So like company ABC gets bought, and then they're under PE investment for like pushing 8-9 years instead of 5 to 7, let's say.
Yeah.
And so what's the option? They can then go,
Well, so what some firms have done is they go, well, we're going to sell the business, and they have another one of their funds buy the business. Or what
oh,
becomes a bigger issue is you've got an acquisition loan comes due, the fund's in runoff, and so they have, the private equity firm may have a private debt fund that then decides to loan to essentially refinance out the original bank financing,
Yeah.
and from the private debt fund, and as a result you've got, or private credit, and as a result you've now got a related party transaction where it's not arm's length, and so
so the same PE firm like buys it from itself.
yeah, like Fund
Oh,
6
Yeah.
buys it for Fund 4.
I didn't know you could do that. Okay.
Well, it's a pretty risky move, because the folks in Fund 4, are they getting screwed, or are they getting
A deal.
premium, or are they, so
Or are they getting like leftovers that like didn't work in Fund 4?
right, and so and again, the article Rory identified did show that, one of the challenges are they're having problems. Private equity funds are having problems raising additional capital because they can't get the
Right.
old capital
Yeah.
out. And
Yeah.
these institutional investors have a allocation percentage that they put toward alternative investments. And so as a
Yeah.
result, they, as we've talked about numerous times on the pod and in the book, the private equity firms make their money by cycling. They liquidate, or they liquidate the investments, or they sell the investments. That's where they get the kind of the ups. So you get your base management fee, you get your real payment if you're a private equity person on the 20% or so on the carry. Well, if you're not getting carry, two things are happening. One, your income's low, and two, the money that folks have said, well, I'm going to put 10% of my money in private equity, that 10% of the money's still in private equity. So you go to try and raise another fund, you can't.
Yeah. Yeah.
So
Yeah.
just so I have it, I think I have it. So let's just say Emily's private equity firm has Fund 4, and in Fund 4 we invested in company ABC. That did not create as much value as we wanted, as quickly as we wanted, and so it's just kind of lingering there. And so to close Fund 4, I'm going to have Fund 6 of still Emily's private equity firm buy ABC company, and now it's in Fund 6.
Well, that happens and can happen, but it's not a good thing, because how do you tell the investors in Emily Fund 4, maybe you're the sole investor in Emily Fund 4, how do you tell Emily Fund 4 that you got a fair price for that from Fund 6, who's basically affiliated with you in the same way?
And
like how do you have a market trade when it's the same group of funds that are buying the next company? You're like, how do you not suspect there's collusion there?
And so what you're saying, Rory, just there, and what I think you were saying, Ed, in a different way, is like the LPs for Fund 4, first of all, could be different than the LPs
Could
for
be,
Fund
but
6.
more than likely the same.
More likely the same, maybe a little bit different mix, but more than likely the same. But they're going like, wait, so when you told me all this good stuff about this company back in Fund 4, and we did our calculations based on what you estimated, you were either lying or were grossly negligent somehow, and so now we're doubling down.
It's like more like there's a cacophony of factors that could have happened. Like maybe your projections on the business are spot on, but the capital markets environment to be able to either raise new debt cheaply or to sell a company in an M&A transaction just not what what would make it a profitable deal if you sold it. So you haven't been able to liquidate the asset for those reasons. So it may not be operational. It may very well be capital markets or just general economy driven.
What happens if in Fund 6 it sits there and does the exact same thing?
Say that again. Wait, what?
So if the company goes from Fund 4 to Fund 6 and it performs the exact same way, it's like a dud in Fund 6.
Well, then Fund 6 is going to probably find itself in a similar position of, trying to get value through selling it at a purchase price that's below or very minimally above what they paid for the company, which is, even if you got let's say a 2x multiple on your investment, that's still going to be considered a failure probably in the private equity space.
Okay, so because we're seeing this trend across the board, do you think this option will become more and more likely to be used?
What I see it happening now more and more is funds are just having to deal with longer duration. They're having to manage that with their LPs, which is difficult because a lot of these LPs are like insurance companies and endowments and things like that actually have pension funds that have obligation to pensioners and to pay out insurance claims and shit like that. So you have to manage your assets and liabilities from top to bottom. So that's just one thing, is just like resetting expectations and hoping that your LPs stick with you. The other thing is one of the other things, of course, is selling secondaries in that fund. So let's say I'm Emily Fund 4 is long in the tooth, 10 years, and its LPs want to get liquid, meaning get their money out. So maybe that means Emily Fund 4 through an investment banker brokers literally the ownership stakes that Fund 4 has in your operating companies to new investors. So they step into your shoes, which then basically allows you to pay your investors back without selling the operating companies.
So it goes to the bank?
Not necessarily. No. I mean, it would just basically imagine like, I don't know, you own a ATM machine and you value that ATM machine based on its future cash flows as, $1 million. Well, maybe I like that business and you want to get out, and I'm willing to pay you $1 million to step in there, and you might take that. And so you no longer have to wait for cash, nor do the people that invested in your fund. You can liquidate them out. And now I'm happy because I like that business and I got a fair price for it. Right? I paid a fair price for it.
Okay. But is that different from the normal course of?
Yeah, because the normal course is that the operating companies themselves are sold. Like the ATM machine itself was sold.
Okay.
You're selling me your stake in the ATM machine.
I gotcha. Okay.
Yeah. Or the car wash or whatever.
Yeah. And the other piece that Rory hit on, and this is a longer term issue, is, and I'll give an example. I sit on the board of a $120 million endowment. And so I'm part of their investment committee. And so we work through some of these items. And this was actually one that we were discussing in our last meeting a week or so ago, which is you've got certain liquidity needs. So for instance, for the next quarter, we need $4 million available. And so as a result, you're going, okay, I've got to
pay athletes. No, I'm just kidding.
Yeah. Well, and so I've got to have that available in cash or short-term securities. Well, when you have alternative investments, and so not only are they managing for overall return, they also have to manage for liquidity and calls, especially when you're looking at, college endowments and insurance companies where you can basically predict what your cash flow needs are going to be. And as we go forward, and private equity has done extremely well. And so as a result, folks have kind of overweighted into those alternative assets. And I think if this continues where you've got kind of a clog in the system where you're not going to be able to get your money back out, folks are going to go, yeah, I can't overweight. I'm going to have to, balance or underweight because I can't rely on when times are tough. When I need cash, I can't get the cash out. And you don't think about that until it actually becomes a problem. And it was actually a topic of conversation we had, it was recently as a week and a half ago.
So do you think that'll make the LPs So the limited partners who are funding the PE firms, do you think that'll make them go, instead of a 10% of our portfolios in PE, like maybe 5% now, because it's so illiquid and it's not guaranteed like it once was?
Certainly possible, but I think that within, let's say, an LP strategy, there's like a few basic buckets. You have fixed income strategies, you have, public equities strategies, you have alternative investment strategies. Like PE will always be part of the alternative investment strategy, and that's maybe going to have a smaller allocation, whether it's 5 or maybe it's 10. Maybe that does fluctuate because of like longer duration. But my guess would be that so long as private equity returns are still pretty strong, somewhat uncorrelated to the public equities, and produce the kind of attributes of an investment that they see, today or 5 years ago, I don't think it'll materially change. I think they're just going to, like, better way to put it is I think they'll just stay in it and roll with the punches.
And how would you define alternative asset?
Something that's not a fixed income instrument or public equities.
So
No,
anything else.
I mean, it could be a lot of different things. I mean, honestly, it's like that would be a really long conversation, kind of a fun one, maybe actually, to do that. But like, fine art, wine, private equity, private credit, real estate could be considered. I actually put real estate in its own category, but certain types would maybe be that. But stuff that's just a little less mainstream, I guess. Aircraft leasing, stuff like that.
Interesting. Okay.
Which would be a fixed income alternative asset. So fixed income and equity alternative assets are two different things too. So it's like
interesting.
Yeah. That would be kind of a fun thought actually to really break that down. I'd enjoy that. But
yeah, we should do it.
Maybe our viewers wouldn't, but I don't know.
No, put a pin in that. I didn't put like PE and like fine art together. I didn't know they could interact, but apparently in certain circumstances, I guess they can.
I was going to say, as we're seeing
commodities is another one. Yeah.
Here locally, PE and professional sports franchise.
Yeah.
Up to 10% of the Seahawks may be acquired by private equity.
Yep.
Wait, what? We just got a new owner.
Yep. And a new owner is required under NFL rules. So, and I think 35% of the business, they can have up to 20 partners, and up to 10% of the ownership can be held by private equity.
So the owner could give up to 10% to PE.
Well, would sell it, but yes. And that's become, in a lot of the transactions that have occurred, that's become a very common structure.
Mm-hmm. Yeah, and NFL is just a little bit behind on that too. I mean, F1, Formula One, there's a lot of private equity money there. I'm pretty sure, kind of European soccer leagues have private equity, certainly have sovereign wealth funds. So the NFL is maybe just getting.
How many NFL teams have PE?
Ooh, I don't know.
I don't know. I would guess that probably any that have transacted in the last 5 years.
Really?
Likely. Yeah.
Okay. Wow.
And I mean, what is a private equity fund anyway? Like, a family office these days acts like a private equity fund, and just some rich person that's got a multifamily office strategy could very well be considered a private equity fund.
Yeah. Okay. So, what other characteristics are there of these zombies?
Well, like I was saying earlier on, is like some of it is not as much like what you see on the outside as far as like, okay, the sale environment, the capital market environment, but it's also like what it is on the inside. So, managing a fund or working for a portfolio company that is in a long dated fund that's, trying to liquidate. Well, ultimately the emphasis then is about how do I extract as much cash out of the business so that I can wind down this fund as possible. So like what I've experienced in a small way is, like if you're a CFO, for example, or even a CEO, so much of your time and energy is less about sort of growing and optimizing the business from a growth and top line standpoint, but rather financial engineering, liquidity and cash, and ultimately again a sale. And so let's play this out a little bit. Some of what you might see in an operating company that, let's say, is doing real well, free cash flow, all that stuff. Maybe the goal, a couple of years prior wasn't to constrain the balance sheet with debt, but maybe now, again, ownership is about making money, not about creating a loving business legacy with your community. No, it's about engineering returns. So if you can't sell the business for a big multiple, maybe you have an opportunity to re-engineer the balance sheet with a lot more debt and other weird securities to be able to pull cash out and let it die. And I'm saying that with a straight face. Like, the death of a company isn't always a bad thing from an investor standpoint if you got as much value as you can get out of it.
Wow.
And wound it down. I've seen
I
that
can
happen all
I
the
can
time.
point. I was about to say I could point to Lone Star Steakhouse.
Ed's literally done it. Like, Ed's been the last guy standing. I've been the second to the last guy standing in some of these businesses.
So they just intentionally kamikaze themselves.
Well,
it's not.
They don't think of it quite that way.
Okay.
Yeah.
They
Because that would
think
also
about
be.
it as, I'm bringing this thing to a logical conclusion. I've extracted all the value I can get out of it.
Or just winding it down. We're just going to wind it down.
Yeah.
To get it.
And
get
then
it
that's
off
where the
books.
vultures then maybe by doing that, it actually creates an opportunity to sell the company, because like the company's value is only worth the expected future cash flow of the business on a present value basis, with a risk premium applied to it. And so
God bless.
So many
God
words.
So my point is, the value of a business is attractive to a certain type of buyer, but if you've gutted it and it's in pieces now, and maybe it becomes attracted to a different kind of buyer. Maybe
What is it
buyers
like
only
to
want
gut
a
it? Is
piece.
that like offshoring stuff, like automating stuff?
In very simple terms, it's like basically cutting off all the expenses you have
Man.
and running it into ground and extracting as much cash you can get out of it.
And probably in the process, if you could get away with it. And again, if I take a look at like some of the companies that I worked with, it's sale leaseback on facilities.
Yes.
It's sale of non-essential assets. It's raise as much cash as you can, dividend that cash out, and then you're running really tight and lean, and everybody's got the pucker factor. And if something happens, it happens. But they got their cash out plus, and that's fine.
Okay.
You
And
lock
that's
in a
the
return.
mindset. Yeah, that's fine.
But you might flip into, inadvertently or intentionally, you might flip into, we go after distressed companies, or we go after ones that are situated like this, and then you're our perfect target now.
Yeah. We don't like this business when it was a functional free cash flowing
Yes.
business because it was too rich for us. And that's not what we do. What we do is we buy component parts, repurpose them, and then stick them to other businesses. Well, then this business that you've gutted or wound down effectively is now maybe actually has a few buyers that would pay a certain price for it. So yeah, it's a really interesting world, and again, it's like what you tend to see oftentimes, again, I'm just drawing on my own experiences and from what I've heard anecdotally, is like companies in this situation driven by the PE shareholders who always have the majority stake for the most part. If they take a controlling financial interest, they're going to have a majority voting interest as well. They're basically like, okay, this is a different business now. A lot of times you see management change out. If you have a growth-oriented CEO and that executive team, probably not a fit for a wind down scenario, and maybe probably pretty expensive for that. So you bring in somebody that's like, basically a tactical wrap it up type of person, to see it through to that next phase, which may be the final phase.
New and different leg of the race.
Yeah.
Yes.
And a growth-oriented CEO is not really going to be that interested in sticking around.
They're not going to want that.
Or like a maintenance CEO.
That's not what they're
story.
about. Yeah.
Know your leg of the race, like a relay race. Know your leg of the race. With this whole zombie situation, who in the ecosystem benefits? Are there I don't know, do VC firms benefit? Do
the employees of the company are probably benefiting to some extent because they're still employed.
Okay.
And the
If
management
they
team
are not being wound down, though. Okay.
Yeah.
Yeah. The in the zombie situation, really, there's limited benefit to anybody.
Oh.
It is the customers, the employees, kind of the stakeholders that are non-financial are to some extent, they're not investor financial. They tend to be benefiting to some extent because the company's still there. It hasn't been sold, it hasn't been merged, it hasn't been, but really there's no win. The bank maybe because they're continuing to have to
Yeah, I was just going to say that. Yeah.
get some interest. They're getting, a loan is staying outstanding, some of those elements, but that's about it.
I think a couple pods ago we compared it to being constipated, where it's just uncomfortable. And it's just waiting for this to happen. Okay.
Yeah.
Are VC firms in a similar boat, like to a smaller or lesser extent, or not really? They have different.
You know what? Maybe the algorithm just hasn't kicked that over my way, but I haven't seen a lot of news like that. I've seen a lot of news along these lines. We've been talking about it specifically with PE for some time now, but I haven't seen the same thing with VC firms.
No,
maybe it is.
VC, the companies are normally in a little different phase.
Yeah.
So at that point,
they don't survive 10 years.
They go down or they get bought.
Yeah,
and
that's true. That's
because they've got really promising something, and so they're gonna get bought, or it's a wind down. I have same thing. I have not seen or heard anything on the VC side. I wouldn't be surprised if there's not some. Again, as we've talked, the VC environment and the PE environment, that line is pretty blurry now. Mm-hmm. So it's there may be, I'm sure there's some in there, but that's not. It's kind of a different. It's a different way that they monetize. So on the VC side, it's really, we're shooting for a 10% success margin at a 30x return. Yeah. And on the PE side, we're looking for a 80% success margin or 90% success margin at a 25 to 30% annualized return. And that's the, and that's the difference. And so as a result, you have a really different investment profile that, is going to, some are going to be able to transact or shut down faster because of their size or the nature of the business versus a relatively mature business.
So let's say this current state of play lasts for, 2, 3, 4, 5 more years. What would be smart to do in that time period that you can't do once these things hopefully kind of go back to normal?
In the current environment, well, I'd be looking for deals on the secondaries market. Like I'd be looking for solid businesses where somebody really needs a liquidity event. Maybe that rest of that fund's actually done pretty well. Like, so, the private equity fund itself has made money for its investors and itself. And you might be able to talk that private equity fund into selling you a business below its intrinsic value, just so they can wrap it up. And they're already kind of the mind, hey, I've done already pretty well here. We just want to get this thing sold, take it off my hands for, whatever. So that's where I'd be playing if I had hundreds of millions of dollars in my own equity capital and I could leverage that up with a buttload of debt. Yeah.
Yeah. I would be saying the same thing. I think this is actually a good time to start in private equity.
It is. Yeah.
To have a fresh fund of where it's a contrarian fund or where it's a, kind of more of a vulture fund. And you go hoover up secondaries. You got to take advantage of the fact that there's constipation to provide liquidity. And
provide the Metamucil.
Yep. And you're going to get, and if you've got the ability and your investors kind of understand that that's what it looks like, you've got the ability to kind of ride this out for 4 or 5 years. It should turn to the point where you're able to get liquidity again.
Yeah, exactly.
Who are secondary market buyers? Are there PE firms, banks?
Sure. Yeah, definitely. I would not say banks. Definitely not.
Okay. Individual
family offices,
high net worth
funds.
individuals. Okay.
Yeah. High net worth individuals, like ultra high net worth. Yeah, for sure. Yeah.
Wow. Okay. This might a silly question, but how do you advertise on the secondary market? Is it just who you know, or is there like a
yeah.
Investment bankers and then the PE folks generally know each other fairly well. It is a relatively small community.
Correct.
We're able to have, pick up conversations. People tend to know who they competed with when they bought the thing.
Oh,
that's right. Yeah, exactly.
That, you go back and go, okay, well, we've got to dump this or we're going to be selling this now. Are you interested? And, there's those kind of opportunities.
That's right. Exactly. Yeah.
Okay. How, does your zombie article say anything about how long this should last? Are they predicted to last?
No, but I suspect it'll last until interest rates come down meaningfully, because I think people can get behind valuations on an intrinsic level, but I don't think they can justify purchasing at these levels without cheaper debt. So
when it changes, do you think there'll be like a watershed of like PE firms going, oh, like get all of these ones off, and then there'll be like a flurry of sells and new deals, and it'll go crazy because they've been stuck for so long? Or
I don't think it would be that drastic. I think my thought is funds and fund managers that are already in the situation have kind of managed their LP expectations the best they can. And so they're all smart people. So they like figure out workarounds and stuff. So one thing they're not going to do is irrationally sell stuff just to sell it when the market starts to turn, because they understand the laws of supply and demand and how to make money and not lose money. So I think it'll just gradually change, because this has been a gradual process to get to this point. It hasn't been an overnight thing either. So it's like 5 to 6, 7 year cycles. The stuff just fluctuates,
So it's
but
more
it may
like,
also be the new normal too. I don't know. Like, could be, because I don't see interest rates going back down to where they were in 2020 and 2021, maybe ever in my lifetime, frankly. So
No.
So like if you were in the small adjustment category and you were a PE firm, maybe you say, hey, we're going to open ourselves a little bit more to the secondary market than we normally do because of the situation, and take a little bit more there.
Mm-hmm.
Okay.
Yeah.
Okay. Cool.
Yeah.
What else? Anything else that people need to know or would be interesting to like? Just keep this in mind. Put this in, feather in your cap. Just kind of keep that in mind for what's going on right now.
Well, I think if you're a seller, so if you're a founder or you're a management team that's looking to sell, recognize that right now the liquidity in the market is low. And is this something you need to be doing today? Is it something that you should be strategizing? Now, again, there's always going to be money out there. You only need 2 irrational buyers to turn into an irrational purchase price. But
exactly right.
The market is not as robust as it was 4 or 5 years ago, and a lot of the big players are struggling with this. Now, the other piece of that is you as a management team may be a legitimate buyer, where before you were going, hey, I'm in the sell mode. There may be opportunities for the classic tuck-in acquisition or strategic acquisitions of some of these portfolio companies or segments of portfolio companies. So, and I'll give an example. The last company Emily and I worked for, we had a division that did home improvement. We did a division that did automotive.
Yeah.
It'd sell off the home improvement side to somebody else. You get liquidity, which you then dividend out and kind of relieve some of that pressure from the LPs. And, if you're the buyer, you probably picked up a good asset at a reasonable price. So there's opportunity out there, but the management teams are the ones right now that I think need to be looking at, when you ask for benefits, that's where the benefit is. And I think management teams need to be thinking about, okay, how do I benefit from this situation? Do we have the ability to do some of those type of acquisitions? And can we really improve our position now so that when the market turns, we're in a better place?
Yeah, and I think we've also seen cases where the original founder who partnered with PE then buys back their own company.
Yeah, I've seen that in multiple cases, and rarely has it gone well. But
now that you're mentioning it, I agree with you. Like, I don't know that I've heard a lot of success stories on that front.
Yeah, but it's entirely possible. And if you're if you're well advised and you're not emotional about it, it can be a great opportunity.
Ooh, a founder that's not emotional about their business. That's
they're out there.
Order.
There's some out there.
I'm sure there are, but oof, I have not met a lot of them.
True that.
Gotcha. Anything else our listeners need to know about The Walking Dead?
I think about covers it. We'll keep folks posted on new developments in this space.
There we go. Yeah. Okay. And obviously keep folks posted on the state of the Seattle Seahawks, because that's the most important thing. About this podcast. Yeah. Oh my gosh. Yeah. That'll be crazy if that happens. Jody Allen was such a good owner.
Yeah, the Allen family were great stewards of a community asset.
Mm-hmm.
Yeah.
Mm-hmm.
We need to cross our fingers that the Koshlos are going to be the same. And every indication is that they're passionate about the sport, especially the son, passionate about the sport, really want to build a winner. The only challenge I think might be, and my antenna goes up a little bit, is you might have a bit of Jerry Jones syndrome, and that has been an intern at multiple NFL franchises. This is a passion of his, and he's the 30-some-year-old that's going to inherit the team, and he may want to turn into the Bidwells, the Browns, the Joneses, and have a heavier influence than a typical absentee owner, and that tends to not necessarily go extraordinarily well with that.
I don't like a lot of the words you just said. Like, he was an intern. He probably thinks he knows more than he does. He's in his 30s, so he's rah, and he just bought a team. He's going to.
By all accounts, though, he's a great guy and really smart.
Okay.
So you kind of hope all that goes together, and it's like, yep, this could be a real asset, as opposed to, it's the Joneses.
I mean, on the flip side, like, he knows more than a lot of owners do about the actual hands-on, day-to-day inner workings of the football team. So I guess that could be a positive.
Which may or may not be a good idea.
Exactly.
But hopefully he knows enough to know that the teams that tend to do extremely well are the ones that don't have the owners meddling every day.
We'll see. And if
we'll
they
find
take
out.
on
I don't
PE,
suspect John Schneider is the guy to like hang around where he's not able to get stuff done that he wants to get done.
Nope, I agree with that.
And he's good at what he does. He proved that in the last draft class, especially.
Last 2 or 3. Yep.
Yeah.
All right. We'll keep an eye on that, because if the Hawks go to PE, that'll be a recurring topic on this pod, because I'll want to get you guys' take on all of that stuff. But with that, we'll wrap this one up, and we'll talk to everyone next time on Private Equity Experience Podcast.
Yeah.
Thanks, Rory. Thanks, Ed.
Thanks, Sam.
Thanks, Sam.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.